In this video, we're going to talk about coupon paying bonds where settlement is on a coupon date. We're going to start with some basic terminology. So first, what is the settlement date? So if you buy a bond today, then it does not necessarily settle today, meaning that you don't necessarily get it today. All right, for bonds that we consider though, we're going to assume that if we trade a bond today, we buy or sell it in the market, then the settlement date is today. It becomes ours today. The reason why this is important is that any cash flows that happen between the trade date and the settlement date belong to the seller of the bond and not the buyer. So for example, if there was a week between the trade date and the settlement date, then any cash flows on that bond during that week would belong to the seller of the bond and not the buyer. Now, it used to be that there's a settlement lag. It used to be that the settlement date and the trade date differed by several days. And the reason for this was that if you bought a bond, or any other asset, but if you bought a bond, it might take some time for that bond to be registered in your name. And so there would be a lag, maybe 3 days or 4 days or a week, which would allow the company who issued the bond to update their registry to know that you own the bond and not the previous person. Now, to start, we're going to make an even bigger assumption that we're going to assume the settlement date is a coupon date. So a coupon is meant to be paid on that date, and we can also assume the settlement date is the issue date of the bond. So basically, every coupon period we can assume to be the same. The next payment, there's no payment today. If you're buying that bond, you're not going to get it today because you would need to be on that registry today, and of course you're not. So the next payment's one period away. And the really nice thing is there's some easy to use Excel functions with which we can do some calculations. So first off, some cash flows. Right? You own $1,000 principal of a 4% coupon bond maturing in 2 years. You're going to receive coupons on this bond of 1,000 times 0.04 over 2, or $20. Now this isn't the only way to calculate coupon amounts, but in the United States this is pretty much how it works. You receive these coupons, the $20, every 6 months. At the maturity, in 2 years, you receive $1,020, the principal plus the final coupon. So in a table form, the cash flows are $20 in half a year, $20 in a year, $20 in 1.5 years, and $1,020 in 2 years. Okay, next we have to talk about prices. Bond prices are a little bit strange in the market, and we have this clean price. So when we see a quote in the market, it's usually called the clean price. And the clean price is for $100 of principal. Now, typically, you don't pay the clean price for the bond. You get quoted the clean price, but that's not what you pay. You pay the dirty price. So the price for the bond that you pay for a bond is known as the dirty price, and it's the present value of all future cash flows that you're going to receive. Right? So you're going to pay a certain amount for a bond in exchange for a bunch of future cash flows. The difference between the clean price and the dirty price is called the accrued interest. The interest that is accrued since the last coupon date. Now, remember, we're assuming our settlement is on a coupon date, and on a coupon date or the issue date, no interest is accrued. So on this date, the clean price is equal to the dirty price, or the clean price is equal to the present value of all future cash flows on $100 of the bond, or $100 principal of the bond. This makes our life much easier. There's one price on a coupon date. The clean price equals the dirty price and is the present value of all future cash flows on $100 of the bond. So we're making this assumption that we're settling on a coupon date to make our life a little easier. Okay, premium discount bonds. If the clean or dirty price, again, there's only one price here, so if the price is above 100, the bond is said to be trading at a premium. If the price is below 100, the bond is said to be trading at a discount, and if it's trading right at 100 or close to 100, it's trading at par. Again, if you think about it, at maturity of these bonds, let's say the bond's trading at a premium, at maturity you're going to receive the principal back, the $100. So if it's trading above 100, it's at a premium because you're going to give more than 100 to get back 100. Of course, you get the coupons as well. Now, just a little bit of market convention here. When a bond is issued, its clean or dirty price is usually close to par, or 100. Now, after the bond has been issued, it can be traded at any price, and typically it trades at a price that is above or below par, depending on where interest rates are relative to where the coupon rate on the bond happens to be. So if the coupon rate of the bond, let's say, is 4%, and interest rates are 6%, interest rates are higher than they were when the bond was issued, the bond is typically trading at a discount. If the coupon rate on the bond is 4% and interest rates are 2%, then the bond's typically trading at a premium. Interest rates have fallen since when the bond was issued. When interest rates fall, bond prices go up. Finally, we mentioned the yield. The yield of a bond is the interest rate, which matches the current clean or dirty price of the bond. The convention in the market, because the bonds are have semi-annual coupons twice a year, the convention in the market is to use semi-annual compounding for yield calculations. We are going to start by doing some calculations for the present value, or the price, and yield for bonds. So the present value of a single cash flow, X, paid in 2 years using a semi-annually compounded interest rate Y is X times 1 plus Y over 2 to the negative 2t. Right, that's just our straightforward formula. The present value of a series of cash flows, Xi, paid at times Ti, using a semi-annually compounded interest rate Y, is just the sum of the present value of each cash flow. This tells us how to take the present value of a bond. And remember, the present value of a bond is the price if there's $100 of principal. Okay, so let's do an example. You own $1,000 of principal of a 4% coupon bond maturing in 2 years. It has a yield of 4%. We want to find the present value of this bond. So let's look through. We have cash flows in half a year, 1 year, 1.5 years, and 2 years. Those cash flows are $20 each, right, for the first three. And the last one is $1,020. Right, the principal plus the $20. We calculate the present value of each cash flow as, for the first one, $20 times 1 plus 4%, 0.04 divided by 2, to the negative 2 times a half. The second one is going to be the same, except it's going to be negative 2 times 1, and so on. We take the present value of each cash flow, we add them up, we get $1,000. And this is typically true. On a coupon date, the present value of a bond is par, or is the principal amount, if the coupon rate and the yield are the same. Now in Excel, we can do this in two ways. We can either lay out a table, as in that previous slide, figure out the cash flows, calculate the present value of each cash flow, and add them up. Or, for this example, we can use the PV function. Now this function is really useful when we're on a coupon date, but it doesn't get us very far when we're not on a coupon date. And there's some things the built-in Excel functions, even on a coupon date, cannot do and will have to do by hand. But it's a useful function, so we should look at it. So the Excel PV function, it returns the opposite of the present value of our investment. It takes the following parameters: the rate, which is the per period interest rate. Since the yield is semi-annual, we enter the yield divided by 2. N per, the number of periods. For a 2-year bond, that's 4. 3-year bond, that's 6, and so on. payment, this is the coupon payment on the bond. Name generally the coupon rate divided by 2 multiplied by the principal. And finally the future value, which is the principal of the bond. We've got one last parameter which defaults to 0. We're always going to keep it at 0. So that's our function. We take the opposite of this function. Basically, what it tells us is how much do we need to invest in order to get the following cash flows, and it assumes that if you're buying something, you have to pay it, so it has a negative number. Okay, so we do the same thing, except we're going to have a different yield. $1,000 principal of a 4% coupon bond maturing in 2 years. It has a yield of 3% this time. The yield's 3%, which is lower than the coupon rate. Therefore, we would expect this bond to be trading at a premium. Effectively, we earn too much from the coupons, 4%. We've got to lose something in the capital, effectively. So we've got to pay a little bit too much for it because we're going to lose that money at net yield 3%. So we can use the PV function, and we put negative PV of 0.03 divided by 2, the yield over 2, comma 4, so 4 cash flows, because it's a 2-year bond, comma 20, the coupons, 1,000 times 4% divided by 2, comma 1,000. And we get $1,019.27. Again, it's trading at a premium. The value is going to fall over time, giving us a yield of 3%, even though we're getting 4% coupons. If we know a bond price, we can calculate its yield. Again, we can use Excel's goal seek function. If we laid out all the cash flows in the bond, we could use Excel's goal seek to find the yield, which gives us the price. Or we can use Excel's rate function. The rate function takes number of periods. For a 2-year bond, it's 4. The payment, the coupon payment, coupon rate divided by 2 times principal. Present value, we need to put the opposite of the present value here. Future value is the principal. We put these into the function, and we're going to find out the yield. We're actually going to find out the per period rate. We've got to multiply by 2 to get the yield. Type, again, that last parameter we ignore. So we multiply the answer we get out of the rate function by 2 to get our yield. So we have a 4% coupon bond maturing in 2 years, has a price of $95. We want to find the yield for this bond. The price, the $95, is for $100 of principal. This is what we use for the future value. Number of periods, it's a 2-year bond, so the number of periods is 4. The coupon is 100 times 0.04 over 2, which is 2. Present value, 95, so we're going to pass a negative 95 in. We use the Excel rate function. 2 times rate of 4, which is number of periods, 2, coupon payment, negative 95, the opposite of the present value, $100 of principal, the principal we're being repaid, and we had a yield of 6.7133. Interest rates have gone up. They're higher than the coupon rate. The bond trades at a discount. Okay, so some limitations here. PV in the rate function can only be used when the settlement date of the bond is on a coupon date. The coupons must be paid exact multiples of 6 months from when you want the bond price. So this is a big issue. Bonds traded all the time. They don't just trade on coupon dates. And so this is a very limiting feature of these two functions. Right? If I trade a bond, if I buy or sell a bond halfway through a coupon date, the period to the next coupon is not 6 months, it's 3 months. That's going to cause us problems. Next, we're going to look at the derivative of the bond price, or the bond, or the PV of a bond, with respect to the yield. So remember, the present value of a cash flow is the cash flow times 1 plus y over 2 to the negative 2t, where y is the semi-annual interest rate, the cash flow is the amount, and t is when it's going to be paid. We can take the derivative of this function, the present value function, using the power rule and the chain rule. So the power rule, we take that power negative 2t and bring it down in front. So we end up with a negative 2t times the cash flow times 1 plus y over 2 to the negative 2t minus 1. And then we have to take the derivative of that inside function, the 1 plus y over 2. That's a half. So the 2 and the half cancel out, and we just end up with negative t times cash flow times 1 plus y over 2 to the negative 2t minus 1. So that's our derivative for a single cash flow. And of course, a bond is made up of a bunch of cash flows, so the derivative of a bond price, or present value of a bond, is the sum of the derivatives of each cash flow. So PV of y is the sum over I, cash flow I, times 1 plus y over 2 to the negative 2 ti. And the derivative is the derivative of this function. Same thing, we've got the minus sign out in front. Sum over I, ti, cash flow I, times 1 plus y over 2 to the negative 2 ti minus 1. We can also use differentials to estimate how the present value of a bond changes when interest rates change. dPV equals the derivative PV prime of y times the change in y. So let's do an example. We own $100,000 principal of a 4% coupon bond maturing in 2 years. We're going to use differentials to estimate the change in present value of the position if the yield changes from 3% to 2.75%. So we know the derivative is the negative sum of ti cash flow I times 1 plus y over 2 to the negative 2 ti minus 1. And we need to find PV prime of 3%. So typically I'm going to set this up in Excel. I lay out my years, I lay out my cash flows. $100,000 principal, 4% bond, 100,000 times 0.04 divided by 2. Those are my coupons, $2,000 every 6 months. At maturity, the 100,000 plus a coupon, $102,000. Take the present value of each of those. We've done that before. And I also calculate the derivative of the present value for each cash flow, and I add them up. My derivative is negative $195,074.95. This derivative is a rate of change of the present value with respect to interest rates. It's a pretty big number. It's negative. When interest rates go up, we're going to lose money. It's a big number, but remember, we're going to multiply by a change in interest rates, which is a pretty small number. So it's going to come out to be something a little more reasonable. So given this, we want to calculate the differential. Our interest rates are going down by 25 basis points. So dPV equals PV prime of y times dy. dPV equals negative $195,074.95. We multiply by 0.0025, down by 25 basis points, and we end up making $487.69. So interest rates go down by 25 basis points, we make $487.69. Finally, we're going to talk about bond duration. So when considering bonds, the market typically does not use the derivative or talk about the derivative of the bond, but instead uses a measure they call duration. Now there are two closely related duration measures, Modified Duration and Macaulay Duration. We'll go through both and we'll see they're pretty closely related. So the duration of the bond is easier to interpret than derivative itself, and so people tend to quote durations. So first, duration comes from the relative rate of change. So recall, the relative rate of change of a function, f of x, is given by the derivative of the natural log of f of x, which is, using the chain rule, the derivative of f of x divided by f of x. The modified duration of a bond is given by the opposite of the relative rate of change of the bond present value, or the modified duration is negative PV prime of y divided by PV of y. We know what that is. We've taken the derivative. We've calculated the present value. So we have kind of a messy formula here. The modified duration is negative the sum over I, ti, cash flow I, times 1 plus y over 2 to the negative 2 ti minus 1. divided by the sum over I, cash flow I, times 1 plus y over 2 to the negative 2ti. This is easiest to calculate in Excel. So it's the percentage change in price for a given change in yield. Now, using differentials, for a small change in yield, dy, we have dPV is PV prime of R times dy, which means dPV, again, we're estimating how much the present value of a bond position changes, is equal to negative PV times modified duration times dy. So we can do, because modified duration is really just an adjustment to the derivative, it's pretty closely related, we can use modified duration to do the same sort of calculations we would do with the derivative. So we own $100,000 principal of a 4% coupon bond maturing in 2 years. We want to find the modified duration of that bond if the yield is 3%. So we go through some calculations, lay out our years, lay out our cash flows, lay out the present value of each cash flow, lay out the derivative of the present value of each cash flow, add up the present values, $101,927.19. Add up the derivatives, negative $195,074.95. The modified duration is the opposite of the derivative divided by the present value, or 1.91. We have a related measure called Macaulay duration. The Macaulay duration is the modified duration times 1 plus y over 2. If the yield is small, then that 1 plus y over 2 is pretty small, and these things are approximately equal to each other. If we look at the formula for Macaulay duration, we see Macaulay duration is modified duration, that big mess, times 1 plus y over 2. We take that 1 plus y over 2 term into the numerator, gets rid of that minus 1, and we get the sum over I, ti, cash flow I, times 1 plus y over 2 to the negative 2ti, which is kind of the time when the cash flow is paid times the present value of the cash flow, divided by the present value of the cash flows. You can think of the Macaulay duration as the weighted average time of the bond present value. Now, for a lot of bonds, if yields aren't too big, if the coupon rate on the bond's not too big, this is going to be pretty close to the maturity of the bond because the cash flows are pretty small relative to that last principal payment. Now we can use differentials to estimate the effect of an interest rate change on the present value of a bond. dPV, again, this is our standard formula, dPV equals PV prime times dy. That shouldn't be an R, that should be a Y inside the PV prime. And then we can rewrite dPV equals negative PV times modified duration times dy. And we can rewrite one more time, dPV equals negative PV times Macaulay duration divided by 1 plus y over 2 times dy. So basically, we can use modified duration, Macaulay duration, the derivative, to do these same calculations. We don't really care which one we're using. We own $100,000 principal of a 4% coupon bond maturing in 2 years. What is the Macaulay duration of this bond if the yield is 3%? Well, given that we just calculated the modified duration, we can adjust it to find the Macaulay duration, 1.91 from the previous example, times 1 plus 0.03 divided by 2, or 1.94. So we receive the average present value in 1.94 years. It's a little bit less than the maturity of the bond. If the maturity of the bond is really far out in the future, it's going to be quite a bit less. For example, a 30-year bond typically has a duration, Macaulay duration of like 21 or 22 years, something like that. But like a 5-year bond would have a duration or a Macaulay duration of like 4.8, 4.9, something like that. 2-year, 1.94. Now, mutual funds report durations. They typically report modified durations. So here's Vanguard Intermediate Term Treasury Fund, VFITX is the ticker. They reported a duration modified of 5.1 years. If you have a $10,000 investment in this fund and interest rates go up by 1%, how much money do you expect to lose? We can estimate the impact of the yield increasing using our formula dPV equals negative PV times modified duration times dy. Present value, that's the $10,000. So negative $10,000 times 5.1 times 0.01. dPV equals negative $510. So basically, if interest rates, our modified duration is 5.1 years, interest rates go up by 1%, we expect to lose about 5% of our value, $510. On May 19th, 2021, the Vanguard Long-Term Bond Index Fund reported a modified duration of 15.7 years. Longer term, greater duration. If you had $10,000 invested in this fund and interest rates increased by 1%, how much would we expect to lose here? Same formula, except instead of using 5.1, we use 15.7. We expect to lose $1,570. If interest rates go up by 1% on that intermediate term fund, we expect to lose about 5%. If interest rates go up by 1% on this longer term fund, we expect to lose 15.7%, quite a bit more. Longer term bonds are affected by interest rates more than shorter term bonds.